Good morning, everyone. You are watching a live market outlook for Monday, 30th of January 2012. The positive sentiment in past 2 weeks of January persists as Euro last Friday extended gains running higher and breaking above some significant levels at 131.45 and 132. That keeps the positive tone still in play for a possible further recovery of the pair after suffering losses at the beginning of year 2012. Overnight session has seen some corrective movements as most of the investors were taking profit as euro and gold as well as sterling rallied higher while dollar was further depreciating against the major currencies. The main focus today remains on the Eurozone summit where Eurozone leaders will likely sign off a permanent rescue fund for the Eurozone, and they are expected also to agree a balanced budget rule in national legislation with the unresolved problems in Greece casting a shadow on the discussion. Actually, the Greece is still main focus. The negotiations are coming close to their end, and there are still rumors that the agreement will be found. As on Friday, the Greek officials announced in the late hours of Friday trading that they are quite close to finding an agreement that will avoid the messy default, which would be the worst scenario, and they're not threatening only Eurozone but worldwide, as this would be the first time that such a big country goes under the water, as we say. The summit today is also expected to announce that up to 20 billion euros is unused funds from the Eurozone's 2007-2013 budget will be redirected towards job creation, especially among the young, and will commit to freeing up bank lending to small and medium-sized companies. Discussions over the permanent rescue fund, a new fiscal treaty, and Greece will dominate the talks. As I mentioned, the Greece is still the main focus. Negotiations between the Greek government and private bondholders over the restructuring of 200 billion euros of Greek debt made progress over the weekend, but are not expected to conclude before the summit begins at 1400 GMT today. Until there is a deal between Greece and its private bondholders, EU leaders cannot move forward with the second 130 billion euro rescue program for Athens, which they originally agreed to at the summit, last summit and last October. Instead, they will sign a treaty creating the European Stability Mechanism, so-called ESM, a 500 billion euro permanent bailout fund that is due to become operational in July, a year earlier than first planned. And also they are likely to agree the terms of a fiscal treaty tightening budget rules for those that sign up. The ESM will replace the European Financial Stability Facility, EFSF, a temporary fund that has been used to bail out Ireland and Portugal and will help in the second Greek package. Eurozone leaders also hope that ESM will boost defenses against the debt crisis, but many, including Italian Prime Minister Mario Monti, IMF Chief Christine Lagarde, and US Treasury Secretary Timothy Geithner, say it will only do so if its resources are combined with what remains in the EFSF, creating a super fund of 750 billion euros, equivalent to 1 trillion of US dollars. The IMF, International Monetary Fund says an agreement to increase the size of the Eurozone firewall will convince others to contribute more resources to the IMF, boosting its crisis-fighting abilities and improving market sentiment. Germany opposed such a step, as Chancellor Angela Merkel said. She will not discuss the issue of the ESM-EFSF ceiling until leaders meet for their next summit in March. In the meantime, financial markets will continue to fret that there may not be sufficient rescue funds available to help the likes of Italy and Spain if they run into renewed debt funding problems. Brief look at today's calendar, which is quite thin. We have German preliminary CPI from the regions that will be running during the day, and no other news from Eurozone. From US at 13:30 GMT core PCE index monthly release. No change expected for today. 0.1% is the forecast. Personal spending at the same time forecasted at 0.2%, slightly better than the previous month release at 0.1%. And the personal income monthly from US increase by 0.4% is forecasted compared to 0.1% previous month release. Let's take a look on the market movements during the Friday's session and the overnight session. As we can see, the euro rallied through some significant barriers at 131.45, previous low of 4th of October, and also cleared the 132 barrier. 131.96, 132.11 were the levels, extending so far to 132.32. That marks exactly 38.2 Fibonacci retracement of the broader down move from 142.46 end of October high to 126.22 mid of January low, also breaking the main bear trend line at around 131. Keeping hopes for further extension and further recovery after being in downtrend from 2011, 1st of May, yearly high at 149.38. The outlook for further gains remains quite positive, as the daily studies are into a positive field and suggesting further extension higher. Immediate dynamic barrier at 133.41 is 90 days moving average on the daily chart, ahead of 50% Fibonacci retracement, standing at 134.29, and then we have lower high of 2nd of December 2011 at 135.47. That will come in the short term in case of sustained break higher. Back to the narrower time frames to see the latest action, as the pair reversed from 132.32 high of end of session of last Friday, hitting levels below 131 initial support, 132 initial support at hitting 131.35, where temporary footstep was found, ahead of more significant levels of Fibonacci 38.2% of 129.30 to 132.32 at 131.17, and the higher platform at 130.80 zone, higher platform of 27th of January. That is expected to contain dips in order to maintain immediate positive tone. Below this, we have 130, currently 130.57, which is the main bull trend line and also the channel support. Break here would be risky for the short-term price action, as it might signal temporary top and allow for a deeper reversal. A loss of very significant support at 129.30 would sideline the short-term bulls and look for a further easing. Cable struggles to hold gains above 157, as second break higher made just marginally higher high from the previous one at 157.33, hitting 157.39 ahead of reversal. This happens just ahead of critical barrier at 157.70. That is still in focus, as the pair remains in the strong uptrend in past 2 weeks, clearing 3 moving averages at 20 days, 55 and 90 days, as well as breaking the main bear trend line. That signals further recovery with the break of this very, very strong resistance at 157.70 to open way for further gains towards 159.65 currently, where is 200 days moving average standing. Hourly studies are currently in the negative territory as the pair broke below 157, so far seen 156.63 ahead of basically tested the initial support at 156.60 ahead of 156.40, and then we have the main support in the short-term price action at 156.00, which is the trendline support, and the previous high of 23rd of January. Loss of 156 might delay immediate bullish action, as the pair is currently attempting below 4-hour 20 days moving average, and ideally the higher low should be left above 156 in order to maintain this 2 weeks long uptrend. Risk of failure, another failure under 157.70 might increase possibilities of ending, might signal an end of recovery phase and the open way for the fresh weakness in case the 157.70 caps the short-term gains. Dollar yen has lost actually the ground after unsuccessful and strong rally last week, cleared some important levels and tested the strong barrier at 78.20-30 zone, but failed to break there. 78.27 high was seen ahead of a sharp reversal. Loss of initial support at 77.60, which was a broken main bear trend line drawn of 124.14 2007 high. Extended losses through 77 as our reference support, losing 76.85, currently testing 76.65 ahead of critical support at 76.50. This is the medium term range floor. Loss of 76.50 would signal further weakness and extension of the broader downtrend of dollar yen, and the possible test of initially 76.10, 76.00 ahead of a record low of the pair posted on 31st of October at 75.56. That was the pre-intervention low, a level where the Bank of Japan intervened last time, and pushed the pair up to 79.52. Some rumors are circulating again as 76.50 level might be a trigger for Bank of Japan to take an action. This is still as seen as a rumor, but there is quite a big possibility of next intervention in case of further strengthening of Japanese currency, as this directly harms the Japanese economy, especially the exports. For now, we are the outside outlook for short term is quite negative, and some corrective action might be seen on oversold near-term conditions, with 77.30 zone expected to cap the upside for now, where also the 20 days moving average on 4-hour charts that's pointing lower stands now, and most likely any corrective action should be capped under this level. As a part of broader weakness of the dollar against Swiss franc continues to trend lower, extending its short-term losses from 96 barrier that stayed intact for now, with the double top left at 95.73 ahead of a strong reversal lower. 91.13 was seen so far, just ahead of 91.00. That marks 50% Fibonacci retracement of the upleg from 85.66 to 95.93, losing recently 90 days moving average on the daily chart, currently at 91.79, and opening way for further extension lower below 91. The next level is again Fibonacci level at 89.55. That marks 61.8% retracement, and below this we have a low of 9th of November at 89.21. Loss of these two levels would confirm the top at 95.96 and 95.73, and likely look for test initially levels at 87.60 low of 3rd of November, and 200 days moving average currently at 87.31. For now, upside remains limited at 92.27 high of 27th of January. Close to it is the 92.09 20 days moving average, and the likely price corrective action would be likely capped at this level. Only break above 93.38 high of 25th of January would provide near-term relief and avert immediate downside risk. Move back to commodities. As we can see, the crude oil December contract is still in, March contract is still in defense, with downside so far protected at 97.40-50 zone. However, recovery attempt failed to regain 61, to break above 61.8 Fibonacci retracement, hitting 137 ahead of further easing. It seems that the pair is currently in the congestion between 97.50 and 101.30, as the upside remains capped and the broader downtrend from 103.72 continues to pressure the price action towards the downside. To avoid further losses below 97.50, we need to see the break above initially 100 as our initial barrier, then 100.61 and 101.37, above which immediately we have the main bear trend line around 102, and then tops at 102.20 zone. On the downside, the temporary footstep was found at 99.40, just above at 99.40 so far, and the pair is looking for recovery. However, the hourly and 4-hour studies are still showing a more negative tone, and possible further easing would be likely. 4 hours 20 days moving average currently at 99.61 caps the upside for now. Gold remains in a strong uptrend, extending gains last Friday to fresh high at 1738 zone, just ahead of breaking above 50% Fibonacci retracement of the broader down move from 1920 to 1522, and extending to 1738, just ahead of our initial barriers at 1756 and 1763. Studies on the daily chart are turning into positive field with fresh momentum, signaling further extension. Overbought hourly conditions see scope for some corrective action with the initial support of 21st, 22nd of January higher platform at 1668. Before this, we have 1700 as lows of 30th of November and 6th of December, as well as figure support. However, the reversal is ideally seen above 1660-70 in order to keep the immediate bullish tone in play. Also, 90 days moving average currently at 1674 is among these supports, as 20 days moving average now crosses above 90 days, signaling further extension higher. Only loss of 1650, where is also the 1650 zone, where is also 200 days moving average, would sideline short-term bulls and look for further easing and possible extension of the broader downtrend. For now, break of main bear trend line keeps the focus on the upside, as well as moving averages of 55 and 90 days that have been cleared last week, keeping positive sentiment for gold for further extension and test of levels at 1756, 1763, above which comes Fibonacci 61.8 at 1767.